Hey everyone, and welcome to VLOG6. Let's get it started with the big news story from last week, which was the jumbo rate cut by the Fed, 50 basis points. I know I was talking of more of a moderated 25 basis points, but hey, what do I know? These guys are the real experts, and may not be that consequential at the end of the day. We want to get maybe a certain rate cut over a 3 to 6 month period. Um, so let's see what happens. 25 basis points in July and 25 in September versus 50 in September may not be that um, consequential at the end of the day. I did watch the full press conference by Jerome Powell, first time I've ever done that. And he got pressed on the softening of the labor market and if he's worried about something, but kept coming back with, fundamentals are still strong. The trend, yes, is softening, but we're still at good levels with unemployment and GDP growth, yada, yada, yada. And it appears now, and rightly so, the focus for the Fed is going to be to maybe look to engineer that soft landing as we are coming out of the inflationary cycle. More focus and more guns on maybe securing and cementing that soft landing, which is going to remain a question mark over the next 3 to 6 months. And every time he was pressed about what's going to happen with the rate cuts in November, naturally the response was, yeah, so it's all going to depend on what happens with data and how the economy performs between now and then. So yeah, overall, I think the markets took. Let's look at the S&P. I don't know, I always look at Nasdaq, given the stocks that we hold, but um, yeah, I think you know the market was kind of pricing it in coming up to the FOMC meeting, and I think it reacted favorably after that. As you can see over here with the Standard and Poor index, it's kind of more or less level. And economic factors only play so much of a role in these things. So yeah, nothing too eventful over there. But however, I will say that the market and narratives and voices do seem to be on edge, primarily due to the softening in the labor market and some softening in the consumer and consumer confidence as well, as you can see over here. There are some contradictory reports around that. So some indexes, at least this one, which is just University of Michigan index, may not be as broad spectrum as the other one. There is hope and some confidence, as there should be, since fundamentals are strong, and we've already seen a 50 basis point cut and seeing willingness from the Fed to be committed to a soft landing. But there is overall edginess in the market, and there's a lot of narratives about, uh, the common doom and gloom as there all always tends to be, but perhaps now more than in recent times. And you even have Warren Buffett. Come on. All right, you even have Warren Buffett making statements like you should be prepared to go down 50% on a stock portfolio or on any given stock, maybe not on a portfolio, but on any given stock um, in this situation, given that overall the markets are at record levels and we could see more sell-off activity. So this report over here by the Motley Fool talks about hedge funds, private equity firms, billionaires selling large portions of their portfolios. And one report mentioned that Warren Buffett is actually now in 50% cash, something like 300 to 400 billion in T-bills. And maybe that's a signal for something, that's about to happen. But if you look at the market over, oh, let's go, yeah, let's stick with Standard and Poor's um, recent history. I think we have seen sell-offs. We've heard about Warren Buffett, I don't know, reducing his position in Apple by 50%, maybe selling off his entire Bank of America stock and stuff. So I think a lot of that has waved through the market already. And if these guys have already sold these stocks and the market is still fundamentally strong and it keeps recovering out of the sell-off activity, I think that's overall good news. That's overall good news. I mean, this is kind of history now, right? That if they've already sold, they're probably looking to sell some more. But the market seems to be fundamentally strong and seems to be withstanding those sell-offs and still retaining its levels and even creeping up a little bit, as you can see. And another piece that I wanted to quickly point out, especially when you're looking at overall economic scenarios and how things are going to weather out over the next few months or so. Household debt levels has a lot to do with that because that impacts the consumer directly. It impacts their confidence. It impacts their outlook. The more consumers are squeezed, which they tend to be expressing in a lot of these surveys and reports, inflation has taken its toll. Housing is still very expensive, and the consumer tends to get squeezed in between. So cracking these household debt levels is definitely something that I think any prudent investor should be doing. And this chart over here is a pretty good look at how household debt levels have trended over the last 20 years or so. So you're looking at a level of about $7 trillion, going up to $17 trillion in household debt. But you got to break it down, right? Most of this is coming out of mortgages. So mortgages going from 5 to over 12, that's the lion's share. That's protected by the value of the home, right? And overall housing prices have done pretty well. So that's not a net debt. It's a well collateralized, well protected debt. The same thing goes with auto. Auto is not um, as strong as home ownership, I would say, because home ownership tends to appreciate over time. But those levels don't seem that elevated, right? This little yellow strip in between is home equity revolving credits, which is kind of tied in with mortgages. So I think we can just look at that as one piece. But the more concerning piece is really the credit card debt, which is more expensive and puts more pressure on disposable income, which is the income that you have left, kind of discretionary spend um, that you have left to spend on items and goods and households and trips and vacations, clothes and other things. And if that portion gets squeezed, it does tend to make the consumer more conservative. Yeah, they're elevated, but they're elevated through mortgages, which itself drives a lot of economic activity. And then this information is also not entirely complete. You need to look at this vis-a-vis population growth, GDP growth, per capita income growth, and other things to fully uh, to come full circle on this. Okay, okay. So let's look at the stocks. The stocks retracted somewhat. Not going to harp too much on that. It's bouncing. Prices are bouncing from week to week. There wasn't really a significant pickup from the Fed rate cut, especially not in this portfolio. But we did add this guy over here. So Navitas Semiconductor. Say hello to Navitas. It's a stock with a good profile, I think, and it kind of meets the price signature and the overall profile that we're looking at with our portfolio over here. So as we go to Navitas, you'll see that same 5-year, similar 5-year trend that I've kind of been showcasing with the other stocks as well. Has decent volume, so decent interest. Not great at this time. It's a bit of a sleeper right now. And if we look at some other factors real quick, first of all, what do these guys actually do? So they produce basically high-end, ultra-efficient semiconductors that generates more power and drive and enables faster charging. So it is tied in, it is correlated with the EV industry. That was one of the why I was interested in it, as well as has some other applications as well in data centers. So stock overall looks good and also has a pretty good research profile. It's covered by a good chunk of analysts, has a strong buy rating at this time, and a pretty nice looking this price target as well. So I may dig into more with the financials around this stock later on, but it's going to be similar to kind of what we've been seeing with the other stocks. Um, so yeah, that's that. And another thing that I wanted to quickly touch upon was that last time we talked about Butterfly, right? Because Butterfly suddenly appreciated about 100% and doubled in stock price, and it's retracted now a little bit, so it's come back to 78%. So it's a bit of a success story, but I also wanted to talk a little bit about a failure story, so to speak, because we can call it a failure story. And that has to do with Polestar. Polestar is an EV automaker based out of the UK that I've had my eye on for quite some time. And it also has that very similar price signature that you can see over here. And kind of what happened back in May when I was kind of dibble dabbling with the market, kind of checking out some stocks and doing a little bit of just one-off random buying and selling. That I picked up the stock, I think, at like around 170 or something, and then ended up selling it around close to a dollar, so about a 40% loss over there. And basically, back then, the Fisker story, which was a crash and burn failure EV stock story with the CV maker that just kind of burned out um, for a bunch of reasons. So that was hot in the news, and then these guys missed their SEC filings and I think Nasdaq filings on some reports. And as you can see, the price really started uh, to lower. So I thought it wasn't worth the risk at that time to hold on to the stock and exited it. And eventually it caught up with its filings. It did have much better fundamentals than Fisker. Sells about 50 to 60,000 EVs a year. Has good well, I won't say good financials, but much better financials than Fisker. Not as bad of a cash burn rate. And then it's now recovered. But it's not so much of a failure or sort of a miss in this situation. The idea is to hold these stocks for longer term. So if I had done that, I guess it would have been okay. But it's still, I think, okay to go with this and wait and see, especially when you're dealing with long-term low price points. You see that if the company comes out of it, the issues that it's facing, and it cements itself and it comes back into stronger fundamentals. And then at that point, I think you can still pick the stock up and it could still end up being a success story over the longer term. And I might actually just do that, but maybe not right away. It given all the economic narratives going on, and sell-offs and recession fears and anxieties in the market, it's okay to wait and see if you can get a better price point, or you may be able to pick up um, more shares of your stock portfolio if everything softens up a bit and get better average pricing. So, don't want to buy up everything right now. I think it's a good idea to do a little bit of wait and see approach with some of these as well. So, not certain about what exactly I'm going to end up doing with this, but definitely something to worth keeping an eye on. The price is low. It's definitely at multi-year lows. And once the EV industry gets back into a high growth phase, stocks like these should do much better. So I'm going to go ahead and end on a spiel by Warren Buffett on diversification. Um, as you can see, you got 6 stocks in here, and already thinking that that might be a little too much. Um, I kind of agree with what he has to say over here right now, so I'll just let you listen to him. But I've got 4 biomed stocks, and I think I want to do a vlog on biomed at some point. But that may be just a little too many, and I'm kind of thinking about consolidating this down to maybe 3 stocks or so in the biomed space. but here's kind of why. And I'll let
Oh my gosh, put it out! Oh,
we
hurry,
talk a little
hurry!
bit about that.
Towel, yes. Hurry, I'm trying to open it with the towel.
We would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out,
Sorry.
strongly about, and that to us. There's nothing magic.
Hurry up.
We like to put a lot of money in things that we feel strongly about, and that gets back to the diversification question. We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number one just strikes Charlie and me as madness. It's conventional practice, and if all you have to achieve is average, it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. Do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. 3 wonderful businesses.
All right, real quick, just as a reality check on this, you can own 2 or 3 stocks, but the thing there is that you don't know if you've picked the right stocks. You don't know if you've picked the companies that are really gonna hit those crucial events and watershed moments, and they're gonna do the right thing even in a high growth industry. They're going to have that access to capital. They're not going to have some kind of internal management issue or something like that that's going to go to the wayside, like for example with the Fisker story. So in high growth industries like EV or biomed AI or something like that, you can hold ETFs, index funds and things like that. And that's what people do because they want to get that growth. They want to be more sure of getting in that growth. And if you go with individual stocks, you may end up picking um, uh, something that's not going to work out, right? Because you just don't know what's going to happen with any given company in the future, no matter how rosy it looks and how good its financials are. So maybe two to three stocks per industry, and just having about 2 to 3 spheres. Like we have over here, EV and biomed AI. Maybe we add hydrogen fuel to this at some point, which I've got to talk about. I've got to get to that because I've been looking at that for quite some time. That may be the way to go. All right, so you kind of get the best of both worlds. Hopefully 1 out of 3 or 2 out of 3 will work out. But yeah, that's that, and we'll stop here. We'll see you guys next time.